Okay, so this video is going to walk through the rest of the options section, or options notes, and so you'll want to flip to page 25 of handout number 5 to see figure 9, which is what I'm showing you here. And we're going to walk through now a two-period example of using the binomial model. And the trick is, for the binomial model, when you especially get past one period, is what you're going to do is you're going to start from the end and work back. So you'll notice in this example, as described in the bullets below the figure 9, that we're going to assume that the price changes every 6 months, and we're going to start off at the 100. So you see 100 here for the stock price, and then the assumption is that the price is going to move 10% up or 5% down each period. So those math calculations are pretty easy. So 100 times 1.10 to get here, and again to get here. Or if you have a down, times 0.95 to get here. And so the first step is generally to work out all the stock prices based on the assumptions given, the beginning stock price as well as what the upward or downward movements are each period. And then to actually calculate the call values using the binomial model, we'll start by calculating the end points and then work our way back. So we're supposed to consider, see bullet 2, we're supposed to consider a call option with strike price 110 in 1 year. So notice that these movements are every 6 months. So at the end of 1 year, we'll be over here for our call. And given that the strike price is 110, we take the 121 minus the 110 to get the 11. And here, both calls, both down, down, and up, down, or down, up, same position, these calls are out of the money, and that's why we get to zeros. And then we'll work our way back. So we're going to deduce C by backward induction. We're going to start from the end and then work our way back. First to figure out what call up is, what call down is, and then our final step will be to backtrack back to the beginning in this two-period model. Okay, so to figure out what these call prices are, we're again going to have to build the perfect hedge ratio. So now let me flip over to the blackboard to start writing. Okay, so the perfect hedge ratio, which we're going to denote as the H star, or asterisk. Perfect hedge ratio is simply comparative to what node you're on. You're going to look at the call up value less the call down value, and then put that over what the stock price up value would be less the stock down price would be. So for instance, if you're standing here relative to two situations and you're trying to find out your perfect hedge, you're going to look at the call up less the call down, and then put that over the stock up less the stock down. So it's relative to what node you're sitting at and what you're trying to deduce value of. Okay, so let's continue on with this example. So if you flip to page 26 of the notes, we'll walk through these steps. Okay, so step 1 is we're going to deduce call up. And so here we're going to again use this new perfect hedge ratio that we've talked about. And so relative to the call up, relative to that node, the next call up is going to be 11. The call down is 0, and we put that over the stock price. So this is the stock up relative to our node. That's where we are, and the stock up down is 1045. Okay, so we do that math and we would get 2/3. Alright, so in order to form the perfect hedge ratio, this portfolio H2, we're going to buy H star. So that is what we just calculated. We're going to buy 2/3 of a share of stock. Okay, And then we're going to write, or as we know, it's also equivalent to the idea of selling. We're going to sell one call. And again, to be clear, in these examples, this one call is just going to cover one share. Okay? And so what's the cost of that? Well, the cost of that, relative to where we're standing, is, well, 2/3 of a share of stock at this node is worth 110, and then we would have to subtract whatever the call up is. Okay? So that's 73 and a third minus call up. Okay? And so now think about what the value of that is in 6 months. Well, if it is the case, we only have two possibilities, right? Well, if it's the case that the stock price at the end of the day is 121, what is our hedge ratio or portfolio worth? Well, it would be 2/3 of that new price stock, so up, and then minus the call that we wrote, which is now call up. So that would be 80.67 minus 11, and that would give us 69.67. Okay, alternatively, what could ST be? Well, ST, the stock price at the end of the day, could be 104, spot 50. And then, what is our H2, our portfolio H2 worth? Well, it would be 2/3 of the value of stock price up down less the call up down. So that is, looking at the chart, 69.67 less 0. So, surprise, surprise, we get the same answer. So this is why it's called a perfect hedge. No matter what happens to the stock price, it could go to 121 or go to 104.5. Either way, our perfect hedge ratio comes out with the same answer. As we know from the replication 3 from last class, that means we just have to discount it back. So by replication, what do? We could take the 3, so repeating, minus call up must equal this 69.67, what we get at the end of the day, and then we're just going to discount that back. And the situation for this example was that the risk-free rate is 10%. And recall, we're only working with 6 months, so we need to only take half of that. Discount it back, and so we get a valuation of 66.27. And so that's the value of what we had up here, right? Okay, so plugging that back in, well, essentially what we're trying to solve, of course, is what is call up. So call up is $7.06. Alright, so there's call up. Now, what we'll want to do is deduce what call down is. So let's clear this. And now we're on step 2. So we're trying to get to, we want call down. And essentially we're going to, do the same steps, but in this situation, look back at figure 9. And what do we see? Well, I can flip back to it. So if we're looking at figure 9, we know that, so we're trying to figure out what, sorry, let's try that again. We're trying to figure out what the value of call down is. And you'll notice that, so if we're right over call down, then we know that we could either be in the up or we could be down. And in either case, we end up with 0. So really we won't have to do any calculations here because no matter what we do, this call is going to be worthless. So therefore, the call at this point, at this node, is also worthless, so it's worth 0. So let me just flip back to the blackboard and we can just move on. So this makes our life much easier here. We could just deduce that no matter what happens to the stock price, the call is going to be worth 0. Okay, so we can move on to the final step, step 3. We're trying to find out this final C. So you can think about the, additional. Let me just clear this. The initial call. What is the initial call? Well, we're now going to start and construct our perfect hedge again. And so, starting from the initial position, what are the possible call values? Well, we have the call value that we just solved for. And here I guess I have another significant digit. But so 7.064 in the up situation, and we just calculated that the call down is worth 0. The relevant prices are up of 110 and down of 95. So our perfect hedge ratio is 0.471. Okay, so what does that mean? This 0.471 means we're going to buy 0.471 shares of stock, so a partial share just like we did before. That's what we're going to buy. And as before, we're going to write or sell one call. So it's always a full call. So the perfect hedge ratio is going to determine how many shares of stock you need to purchase, generally a portion. Then you, at the same time, you're going to write one call. Okay, so what's the cost of getting this position? The cost is going to be 47.10 minus whatever the call is worth. Okay, so again, what's the value in 6 months? Well, if it's the case that the stock price goes up to 110, that means our perfect hedge ratio, which I'm going to call now, this is H1, that's going to, of course, equal 0.471 times the share of stock, the price of S up, and then minus call up, pardon me. Okay, that would be 51.81 less the, again, 706 that we calculated. So this position will be worth 44.75. And as you can probably guess, if it's the case where the stock price actually goes down, our perfect hedge ratio is going to maintain the same value. So let's prove that. We would have a valuation of 0.471 times S down minus call down. That would leave us with 44.75, and then our call is worth 0, as you might recall. And so, of course, that gets us the same 44.75. So, surprise, surprise, our perfect hedge ratio comes out with the same answer. So now, by replication again, we can just discount it back to solve for our call. So again, up here, since the cost of this position was 47.10 minus whatever the call is worth, it must be the case that it's going to equal simply the discount of this certain valuation. So 44.75, and then we'll just discount it back at our risk-free rate. So take half of the 10, and we get a value of 42.57. That's what the right-hand side works out to be. So if we just do a little algebra, our call price is going to be worth 453, and that's what I filled in on the diagram. Okay, so now picking up on page 27, we're going to walk through essentially the generalization of how to solve a call or evaluation of a call using the binomial model. So let's clear out this blackboard, delete, and walk through the generalization. So the first thing you're going to want to do, or at least recognize from these models, is that we're going to, I mentioned in class that it's a very flexible model, and so we're going to assume that at any time variable interval, the stock price is going to move, right? It can go either up or down. So we just call these factors. So the stock price can move up, or stock price rises by factor u, and of course that's going to be greater than 1, or drops by factor d, drops. And d is going to be less than 1. Okay? And notice that the interval can be of any length. And so to generalize, we can just use a tau to generalize. So in any interval, they're going to be fixed, so 6 months or a year, but you can set your model to be 3 months, however you want to have the repricing work. Okay? So at the beginning of any time period interval, what are we going to have? We're going to have, at least we'll be told, some kind of stock price, S, and then the goal is to solve for C. Okay, you can think about that. This the original C naught that aligns with that first stock price. Okay? And then the stock price will go up. We have ups, and then that's tied to solving for a call up, or we have an S down, stock price that goes down, and then that's mapped to a call down. Okay? So then the call premium at the beginning of any interval, so the premium, and recall that's what we call the call price, the premium at the beginning of any interval so again, notice that at any node, it's relative to, so this is the beginning of any interval, and so compared to that node, you have an up and a down. So the premium that you're solving at the beginning of this interval is going to be based on the following formula. Your premium equals your perfect hedge ratio times the stock price minus the quantity, your perfect hedge ratio of the up less the call of up, and then you just discount that back. So again, you take your risk-free rate, and you're going to, of course, base it on what the interval is. And I'm running out of room, so I'll clear the board here, or I could probably squeeze it in. Let me try to squeeze it in. So here I put it in terms of the stock price up and the call price up. But of course, as we saw, by construct, you can alternatively use the down mechanism and get the same answer. So you can do stock price down, call down, and do the same type of discounting to get your call price, call premium, at the beginning of this interval. And for, again, just to replicate this in your notes, recall that, how do we calculate this perfect hedge ratio? All we did was put the relative change of the option pricing. How did the option price change relative to how the stock price changes over those two possible outcomes? Okay. So at the end, so you do this for every interval, right? At the end of n time periods, or time intervals, so we've only done 2, but you could conceivably have modeled out several time periods. So at the, again, you're going to work from the end and work back. Start at the end and work back. So this would, if you have n time intervals, you would have n price changes, right? And the distribution of ending stock prices ST is given by the binomial probability distribution. So a little statistics here. And that should be pretty intuitive. We're only working at each node with 2 possible outcomes, so it's a binomial probability. Okay, so let's let x equal the number of time intervals, or number of price increases. Same thing. In n time intervals. So x is element of our counting numbers, essentially. And we'll let pi equal the probability of u. Okay, then the probability that x equals a specific outcome is our wonderful factorial. So we have n factorial over x factorial times the quantity n minus x factorial. Move pi to the x power times 1 minus pi to the n minus x power. And so this is one of the beauties of this model. We have a nice distribution based off of a very simple underlying price construct. And let me clear to this page to get our final bullet point here. So let's an illustration. Let's have our opening price be 10, our up factor be 110, our down factor equal 95, and we're going to have n time periods. So that would be n price changes, right? And we're going to say that pi equals 0.5, just like we've had before, right? Same probability of being up or down. So what I'm doing here is just pointing out how what values those would take in the general binomial model that we're assuming. As the time intervals get shorter, so what would that mean? That would mean the n would be approaching infinity. So as intervals get shorter, we can think about very minute changes, and that would also mean that our interval size gets very small. What happens is the binomial distribution approaches the normal curve, and that's why essentially one of the main reasons why this model is very conducive to trying to predict, or at least model, replicate what we see as outcomes. Okay, 3 final notes before we move on to the Black-Scholes model. I'll just start with a new page here. Okay, number 1. If the stock pays dividends, what we're going to need to do, we'll substitute S prime for S. So we'll subtract out the D for S naught at the beginning of the tree. And then let this S prime move up and down. Given where the dividend gets paid. Okay, second note. Notice that we've only been talking about calls in this. So to calculate a put, the value of a put, you can use the put call parity. Type in put call parity for European options. So you would calculate the call at every stage of the binomial model, and then use this put call parity to back into the put value. Okay? And then, so notice that that would give the true equivalency of the put call parity is good for European options, but let's think about American, to determine the value of an American put. And recall that just means that it could be exercised early. We can substitute the intrinsic value at any stage of the tree. Let's try that again. So if the intrinsic value at the end of a period exceeds the computed value, then the option would be exercised. So essentially, for the American put, since you can exercise early, you need to see whether or not you want to exercise it early at any given period, and you're doing this by backward induction. And then you would recompute the premium at the beginning of every interval. Okay, so let's finish up with a discussion of the Black-Scholes model. And so if you flip to page 20, you should be on page 28 now. You'll notice the model description. And so let's just walk through what type of inputs you'll need for this model. Well, obviously you're going to need the stock price. So whatever the stock price is right now. And then you're going to, depending on what kind of option you're valuing, you're going to want to know the strike price. You're of course going to want to know the time remaining to maturity, and then you'll want to know the dividend yield if there is a dividend. So things. So what you'll notice is these are things that are easily observable. That's why this model is used for active pricing. You also will need to know or have an assumption, I guess, on the risk-free rate, and then you will finally need to know something about the volatility of that stock price, because recall that that's fundamental to option pricing theory. The volatility does have an impact on the option value. Okay, so now I'd like to turn your attention to figure 11. So let me just bring that up. So this is to point out the difference between what we just talked about. So on the binomial model, the assumption or the distribution that model creates is a normal distribution, so something that we're very familiar with. But in actuality, stock prices follow more of this log normal distribution that you see on the left, so figure A. And that's going to be the underlying assumption, or what the Black-Scholes model uses. The Black-Scholes model does not assume that stock prices are normally distributed. It's going to use this log normal distribution. Okay, so how is that going to affect what we do? Or let's walk through the steps. Okay, so let me clear off so these are the basic model inputs, and let's spend some time understanding this. Okay, so continuing at the bottom of the page there, let's let RT, and so that's going to be the discrete rate of return. On a stock during period T. And so what does that mean? That the stock price at ST, well, that would just be simply multiplying the prior period stock price to get to the next period. So that's what we mean by discrete, just like we've been doing with the time value of money. Okay, if we rewrite that, we could just say that our 1 plus this discrete rate of return equals the relationship, or is equal to the current stock price divided by the last period stock price. Okay? If it is the case that this RT is the discrete rate of return, we can go back to, as you might recall, what Cochrane used for gross returns. He's using rates using R. But this is going to be a little it's actually a little different in notation, because he was using that as gross returns. We're going to, in this notation, we're going to say this capital R is the log of 1 plus RT. And as soon as we do that, we're going to say this is the continuously compounded rate of return. Three. So the Black-Scholes model assumes that this is normal. The R is normal. So if we set R to this 1 plus the log of 1 plus R, we're going to say that R is normal. But if R, which equals this log, is normal, then 1 plus R is log normal. That's what this means. Oops. Let's try that again. Okay. And then finally, the final note here. So one final note on comparing the discrete returns to the continuous returns. And we'll do this by looking at the mins. Okay, so 4. So notice that the minimum discrete return discrete return would be when you essentially lose everything, right? So your return is -1, and that would happen when your outcome is 0, right? You lose everything. Okay, so if that's the case, then min RT would be log 0, which we know equals -infinity. So is the minimum of the normal distribution. If we assume that stock prices were normally distributed, we could get actually that S stock price gets less than 0, which we know is a logical impossibility. So just kind of something to be aware of when we're going to this model. Okay, so in order to use this Black-Scholes model, we listed the inputs, and the one input that I guess we would need to calculate or find out would be trying to find out what the volatility of the stock is, and generally we would use that by looking at historical volatility. Okay, so how would we set that up? Well, we could say, let's say L is the periodicity that we're going to look at. So partial of the year. If we're going to use monthly data, it would equal 1/12. Okay. Well, what would our rate of return will be? Well, again, we're going to use the change in price. So take the log of a current price minus the prior period price, and we're still going to use counting numbers. Okay, then we get to our variance. Look over end periods. Look at how our return varies over time relative to some mean. And since we're sampling, we'll divide that by n minus 1. So our estimate of sigma, since it's estimate, we put a nice little hat on it, will just simply be this square root. And then we're going to get the right units. Okay, some things to note. Number one, most stocks, if you're trying to figure out if the answer you got seems reasonable, well, most stocks have a sigma between 0.15 and 0.50. Something to keep in mind. Generally, the recommendation, or a common recommendation, is to use daily trading data. So if that's the case, you'd actually have your L of being something like 1 over 252, because there's that many trading days in the year. The markets are only open during, the work days, and then you have holidays, so you have about 252 in a year. And you probably want to do some kind of sampling, a decent sized sample. So let's say, a couple months to even as much as a half a year. And then, of course, again, dividends will complicate something, some of the pricing. So if a stock pays a dividend, D, on day T, then you're going to revise slightly your formula for return. You're going to take the log of ST plus D over the last trade's price to adjust that. Okay, finally to the actual Black-Scholes formula. So now we have ways to get all the inputs. Well, these are in the book, so you can look this stuff up. But let's look at a European options and make life simple and not think about dividends. Okay, well, first we want to come up with a revised strike price, and similar to what we've seen before, we're essentially just going to discount this back through time. So compare what the maturity time is and subtract out the current date, essentially. So how discount it back, discount the strike price back in time. Our D1 value is log of the price over this revised strike price divided by, there's our volatility, and then we're going to again look at how long we have left. 1/2 of that same value. Okay, D2 is D1 minus sigma T minus little t. We're going to take these values and we'll plug them into a normal distribution. Okay, so for the European, again we're looking at Europeans option prices. For the call, we would essentially, the idea is, well, let me draw that. So you would take the current stock price and then plug in that D1 into the normal distribution. Sorry, that's not an equals. Then you would subtract out the revised strike price, and again use the normal CDF, normal distribution, and plug in your D2 values. So these D1 and D2 are simply plugging into the CDF. The way to think about this formula is this is the delta of the share price, and then you're subtracting out a bank loan. Okay. For the put, do something very similar. You now take the revised strike price, use the CDF, normal CDF, and then do essentially the reverse. And sorry, notice actually these are negative D2 and negative D1. So really, to use this Black-Scholes formula, you're just going to be plugging in. The main thing to solve for would be to figure out or determine what you think the volatility of the stock price is. After that, you're just plugging into the formula and seeing what the Black-Scholes model spits out as valuation. And again, this is the CDF of a normal distribution. And that is the Black-Scholes model.